Hello, everyone. Again, this webinar is being recorded, so I wanted to say that right off the bat. Again, welcome to our webinar, Let's Get Fiscal. This webinar is part of Northwest's Financial Wellness Series. My name is Denise Kitchen, and I'm the Business Development Specialist of the Retail Sales and Service Department. Our department manages the partnerships the credit union has with organizations so that they can offer credit union membership as part of their benefits package to their employees, members, and volunteers. First of all, again, thank you so much for your interest in our webinar today. And secondly, I'd like to go over some housekeeping items. Everyone is muted due to the number of participants. We ask that you hold your questions until the end of the presentation and then ask them via the chat feature, which you will find at the bottom of your screen. And you can pose those questions when we get to our Q&A session. We encourage you to use the reactions button, which should be right near your chat feature, to let us know how we're doing as we go. We will be raffling off a $25 Visa gift card after the Q&A session. So please make sure you stay tuned until the very end. We will then ask a question regarding content, and whoever is first to answer correctly will be our raffle winner. Ding, ding, ding. Without further ado, I'd like to introduce your presenter today, Chris Greenhill, who is our very own private relationship manager. He has been working with people for over 15 years to help them achieve their financial goals by developing and implementing financial strategies that are customized for them. Chris, now without further ado, go ahead and take it away.
Thank you so much, Denise. I'm super excited to be with you all today and talk to you today about how to get financially fit and retire smart. So thank you for taking the time to register and join us today. So we all know about physical fitness and how important it is as we age, but so is financial fitness. We often skip our financial workouts even more than we skip our physical ones. The result is financial flabbiness. Today, we're going to show you how to get in shape and stay there. That's because it's never too soon to prepare for retirement. In fact, the earlier you start to prepare, the easier it is to save. We know very few Americans have a plan for retirement savings or the confidence or high confidence in the plan that they have that will actually meet their goal or desired lifestyle. So we'll focus on the importance of setting aside time to understand your retirement needs and making a plan on how to meet them. Before we talk about retirement, though, let's review where we are as a country right now. Here's a hint. We're not in good shape, you all. Almost half of the U.S. households out there don't have anything specifically saved for retirement. So we have a lot of work to do here. Last year, the average Social Security check was just over $1,500 a month, which adds up to just a little over $18,000 a year. Now ask yourself, did you live on that? And if you're in Northern Virginia, I'm sure you know the answer to that is no, not very likely, especially as you age and your healthcare costs grows along with inflation. Okay, that's enough of those numbers now. You get the idea, right? Where we are and what we have to do. Retirement is hard for most of us to save for, but regardless of your age, it's not impossible. In fact, like any workout, you get out what you put into it. Unfortunately, like a lot of workouts, it's front loaded. In other words, you don't notice the results right away, but once you do, it's easy to stay motivated and chart your progress. So let's get started, y'all. With any workout, it begins with measurements. How much do you weigh? What's your standing heart rate? Without data like that, you might push too hard or not push hard enough. Well, the same thing happens when we get to talk about what we call retirement shape. We need to assess where you are now so that we can design a personalized plan to get you financially healthy. Let's review our key numbers here. Everyone's heard of the term credit score, and everyone knows it's important. Beyond that, very few people really understand why it's important. Sure, you might know that a higher credit score, you'll get a lower interest rate on a mortgage or a car loan. And you probably know that if you don't have a good credit score, you're going to get a lousy credit card terms or maybe not get qualified for that loan. But a credit score is also a sign of solid financial health. Why is that? Because the folks like us who determine your credit score use several measurements to come up with your number. If you need help building or rebuilding your credit, Northwest actually offers a product called First Card, which gives our members an opportunity to establish and rebuild credit. And it has low minimum balances and it gives you a low minimum balance and no variable rate on the card. So it's a great product to use if that's what you need. 65% of our credit scores out there comes down to two questions: rather, how much debt do we owe, and how often do we pay our bills on time? So if you trim back on your total debt and make your payments on time, your score will soar. While a 700 is considered good, most Americans fall somewhere between 650 and 750. But even more importantly, it's a sign that you're getting financially healthy and freeing up cash that can be put towards savings vehicles like retirement. While almost everyone has heard of credit scores, very few people have heard of debt to income or debt to income ratio. It's called DTI for short. It's a number that lenders like us certainly know very well. We use it to determine if you are qualified for a credit card or a mortgage or a car. To figure out what your debt to income is, it's pretty simple. You just divide your monthly debt payments by your monthly gross income. Lenders like us usually like to keep your, we really like to look at your debt to income to determine if you're qualified for the loan that you have and if you're qualified to pay off a future loan. So let's say that you added up all of your debt payments above and it comes to $2,500 a month. Now, let's suppose you earn $7,000 a month in income. When you divide your debts into your earnings, you get approximately 36% based on this example. That's your debt to income. Ideally, you want to keep your debt to income around the 30% range because lenders like us like that because we can see that you're financially healthy. But whatever your debt to income is, it's nice to know where you stand. Now, how about your net worth? This number requires even less math. Is pretty much just assets minus liabilities. And in my slide here, you see examples of what assets and liabilities here that we're talking about. If basically everything that you value, that you own, subtracted by everything that you owe is really what it's made out of. If your net worth is upside down, meaning that you owe more than what you own, that's a big warning sign that you need to get into financial shape now. Now, as you're thinking about your mortgages and your car loans and things like that, keep in mind that these debts are attached to an asset that also has value. So factor that into your net worth. Here's an example that I like to use to help you kind of look at this net worth and analyze it more holistically. Basically, it's called a personal financial statement. And a personal financial statement is helpful for you to gauge where you are as it pertains to your financial fitness. If you've seen a personal financial statement before, it's probably why you were applying for some form of loan. But if not, this is an example of one. I like to use the personal financial statement as a tool to kind of gauge where my members are financially and also ensure that they're progressing year over year based on what they're trying to accomplish. Emergency savings, you hear that all the time, right? And the reality is bad things happen to even the best of us. So even as we talk about whipping you into retirement shape, you need a cushion so that you can softly land in the event of layoffs, illnesses, or accidents, or natural disaster. That's why all financial experts say that you need an emergency fund. But those same experts don't always agree with that dollar figure or what that is. Some insist that you need several months of living expenses set aside just in case. Others experts acknowledge that most Americans just don't have enough money to do that, especially when they're paying steep interest rates on credit card balances. The reality is there's no set amount or percentage that works or makes sense for everyone, not one specific figure. There are two suggestions here on the slide, though, I like to focus on. The first is $1,000. $1,000, where I got that is, it's a good goal if you don't have any emergency savings at all. You don't have anything in place, this will be good to have in place because it covers a lot of unexpected expenses that can come up, you know, like a car repair or medical expense. That type of emergency fund will help cover that type of expense, and it's not overwhelming to save for. But it won't likely protect you in the event of lost income. There's been a lot of stimulus that's been given out over the last year or so, and even more with the child tax credit coming as well. This may be an opportunity to evaluate where you stand and see how you can maybe you know, prop up your emergency fund and take advantage of the fact that you're receiving that stimulus. I also like the 3-month expenses as a larger, more advanced goal because it's catered to your lifestyle, because it's focused on the expenses. And basically what that means is what your expenses is basically based on your lifestyle. And you can determine really what's going to be necessary to make sure that you're able to pay your bills and sustain the lifestyle that you currently have. Okay, now that we've gone through the initial assessment, let's talk about flexing some financial muscles here. We just hit you with a bunch of numbers, and the results might not be so good for all of you. But don't get discouraged. You know, just know that you're not alone, just like we talked about earlier. But that's what workouts are for. They slowly improve your conditioning. Now let's look at what's holding you back, or some of the types of things that can hold you back, and kind of how you can push past them. Financial literacy is a fancy way of saying learning more about money. In fact, we just tackled in the previous section, we discussed concepts like debt to income and emergency funds and net worth. If you want to keep up with financial literacy, it's not difficult. There's so much information out there, and there are a lot of people out here to help you navigate through your financial education. Northwest is all about providing financial wellness and literacy to our members in the community. We regularly host events like this on a vast variety of topics that will keep you financially educated. So be sure to continue to visit our site and register so that you don't miss out on these events. Not budgeting. If you don't stretch before you work out, you can easily pull a muscle. Well, if you don't budget before you get in financial shape, you definitely can hurt yourself too. Budgeting it's not as hard or boring as you might think. These days, it's easier to keep track of your expenses and figure out where you are and where the opportunities are for you to save. There are a bunch of secure online program apps out there that do the math for you. Each are different enough so that you can find out what fits your personality. For some simple tools that are connected directly to your account, check out Northwest's budgeting tool. It's available through our online and our mobile banking app. You can see where your money's going. You can set goals for saving and even more. There are other services out there, as I mentioned, like Mint and Tiller or Envelopes. These are other budgeting software programs that have a lot of different functions that make tracking and budgeting quick and easy for you. Some have costs associated with it, and some are free, like the tool that the Northwest offers. But ultimately, if the tool saves you money, it might be worth it to pay that cost. Too much debt. This might seem obvious, but we're talking about a certain kind of debt. If you have a mortgage with a low interest rate and monthly payments you can afford, you are building more equity in your home than you're spending. That's good debt. Well, what's bad debt? You know, credit cards. The average interest rate on credit card in this country floats somewhere between 14 and 19%. If you carry a balance, and almost 40% of Americans do, that's a lot of money that we're just handing to someone for the privilege of buying stuff. Cutting down on credit card debt is the #1 way to shake loose money for savings for emergency and retirement. How about needless spending? So this is a tough love moment for you. We all agree that we should spend money wisely, right? It's like saying that we should eat healthy, but we all have our moments of weakness when it comes to spending. Some of us need the latest smartphones or fashion, even if our current tech and clothing is working perfectly fine. In fact, most needless spending is caused by one thing: vanity. Vanity, you all. We want to impress our friends and even total strangers, but guess what? Retiring comfortably is the best way to fill everyone with jealousy. Stop buying stuff that make you look good in front of others. Save now and feel good later. Leaking money. Prior to COVID, I want you to think back and ask yourself for a moment, how often am I going out to eat lunch? Am I going out every day or multiple times a day? Are you paying for phone services that you aren't using? Is your home insulated so that you're not heating and cooling nature? Are you using cable and streaming services? There's only so much television you can really watch, so you really have to take these things into consideration. Many of us don't really tighten up on our spending because, hey, it's just a few pennies here and there. But it really adds up each month, each year, each decade. It's amazing how much less that you can pay for almost everything if you just pay attention to it. Now let's address some of the challenges. Now that we've addressed some of the challenges, let's talk about some of the strategies that you can implement to really get you on track and really financially fit. The easiest way to save for retirement is with other people's money, namely your employer. If your workplace offers you a 401k, pounce on it. Thankfully, nearly half of the employers out there offer matching programs, and according to our federal government, sometimes these employers chip in a quarter or 50 cents on the dollar you deposit for your 401k. But there's still limits on terms of how much you can contribute to these plans, as well as how much your employer can. But the bottom line is still free money. So don't leave that money on the table. Make sure that you're taking advantage of those matching funds. Also, just like most retirement products out there, you can't access your retirement money until before 59 and a half in most cases without being penalized. But you can put a considerable amount of money towards your retirement through vehicles like 401k. So take advantage again of the matching funds. Best of all, you're not taxed on the contributions until you take the money out, which means more money is earning interest instead of going to the IRS. IRAs are also a powerful retirement tool, although not quite as powerful as 401ks. For instance, you can't quite contribute as much towards IRAs as you can 401ks, but they still offer great benefits to a lot of people. And there are different types of IRAs, your traditional and your Roth. Traditional IRAs offer you pre-tax contributions. So you're getting tax deductions for making contributions into these funds so that you can report less income now based on your contributions to that IRA. So that money can go in and continue to grow without it being taxed, so it can grow more aggressively as well. There's Roth IRAs. Roth IRAs, you don't get a tax deduction for contributing directly into a Roth, but you also can continue to grow your money without being taxed while those funds are in the Roth. And the best part is when it's time to retire and you draw those funds out of the Roth, you're taking those funds out tax-free in retirement. So I just want to let you know, we have an awesome IRA team here also that works on establishing IRAs and giving our members great advice on where they stand as it pertains to their IRAs and contributions. So if you don't have one, or if you want more information on getting set up, definitely reach out to us. We can help you out. IRAs are available from most banks and even from some employers as well. So far, everything we discussed, 401ks, IRAs, even emergency savings, they all have one thing in common. You can set up automatic deductions from your paycheck to fund these savings plans. In other words, you can approve a chunk of funds of your money to come out of your paycheck before you get it. There's no better way to save than to not see the money in the first place. Depending on where you work, your HR or payroll department will let you set up multiple automatic deductions. You can send any amount directly to a savings account, so it never tempts you by showing up in your checking account. One great way to save for retirement is to live off the paycheck that you have now. And anytime you get a raise, send that money directly to your 401k or IRA or investment account, or other savings vehicles. And if you do this every time you get a raise, you'll be saving by essentially by not doing anything. You're just saving that extra money that even though you've increased your income. Another great strategy is to take a look at your life insurance policies or policy. If you have a permanent life insurance policy, you might have noticed it has cash value. Now, I'm not a financial advisor or an insurance agent, but I do want to give you some tips here that you should know about. Did you know that you can make withdrawals and even loans from life insurance policies in most cases? Even better, the cash value earns interest, which isn't taxed until you make a withdrawal, and loans aren't taxed at all. Depending on how old you are, this cash value can stand in for an emergency fund, allowing you to save sooner for retirement. And if you need access to it, that money can help you in retirement. Since most life insurance policies is taken out by parents of young children, it's often not needed when those children are grown. So it becomes a retirement policy. Of course, insurance can get complicated, and they have there's lots of rules and policies that are in tax implications that can apply to these type of policies as well. So it's important that you consult with an advisor before making a decision. So while it may be a good decision for you, you should consult with an expert like the people here at Northwest Insurance to help you find out what works best for you. We touched on, insurance policies, but there are so many other investment vehicles out there: mutual funds, stocks, bonds, treasuries, digital currency, real estate. They all have benefits and risks associated with them. The point here isn't to dive into the specifics of each type, but to know that you should familiarize yourself with any investment that you participate in. Ask questions to experts in the industry to help you understand those risks and how it applies to you. How does it fit your goals? How does it fit your objectives? Whatever investment vehicles you use that you implement, don't just set it and forget it. There are changes in economic conditions where your investments perform better at some times than others. And obviously, as you change, you go through different stages in your life, and things happen where you may need to make changes to make sure that your goals are still being met. So we're not talking about becoming a day trader here. Within your 401k and IRA, you have investment options, but too often we don't really pay attention. These retirement vehicles often let you invest automatically in middle of the road, mutual funds. It's really easy to select your investment option and say, well, that's it. I'm all set now. You should study those investment options for yourself and continue to go back and review them. If you're young, you may have more time to invest more aggressively so that you can ride the ups and downs in the market and still meet your investment goals over a longer period of time. But even if you're approaching retirement, you can squeeze some value out of your investments by simply tweaking them according to best practices. If you work with an expert, they can talk to you about your investments and help you better understand and help you visualize what risks you can and should be taking. Now, there are different types of experts out there and they do different things, and they may or may not charge for services and advice. I'm the private relationship manager here, or PRM here at Northwest. And I work with people on the bank side, not the investment side, to help people understand their financial goals. Just like we discussed earlier, I start with an interview to get to know you and your goals and challenges. Once I've collected and analyzed the information, I help my members find the best strategy. Sometimes that's making changes to their existing accounts, and sometimes this includes introducing people to different advisors or experts that I have access to. What a lot of the members that I say they work with, what they truly enjoy the most is knowing that they have a direct contact here at Northwest and my team that know and understand what they're trying to do and can make their banking easier for them. There are many companies out there that charge for consultations, But one of the great things that Northwest extends to its members is they actually, in our partnership with Northwest Financial Advisors, our subsidiary, is that we don't charge our members for a consultation. If you have any reservations about seeking help and advice based on how much you have or how much you currently understand about investments, you're not alone. And that's why I'm happy that our members are able to take advantage of that free consultative service. We have a tremendous team here that has continued to provide our members with award-winning service. The main thing to keep in mind here is that you are the one running the ship, but we're here to help you to make sure that you get to your destination in the most effective way. Also, I want to just touch on one more strategy here, and that's delaying or taking Social Security. So delaying and taking Social Security is definitely a strategy you should consider. This isn't a strategy for retiring early or even on time, but it's the best way to plan for it. While the years will change depending on when you were born, right now, retirees can take Social Security at age 62. The problem is their payments will reduce for starting so early. If you wait until you're 66, they'll get the full benefit. But if you wait until you're 70 to start pulling money out of Social Security, you'll get a bonus of almost 1/3. As you can see, the longer you wait, the more you make. If you are in good health and you expect to be later, an advisable plan for your retirement may be to delay Social Security until you're at least at full retirement age. Again, our financial advisors here run personal and accurate analysis to help you determine how to maximize this benefit. And they offer presentations on these strategies as well. So that's also something that you can go back and reference and know that that's another way that you can educate yourself. So again, I recommend step 7, an expert to discuss the specific, the specific things that apply to you, especially on how and when to draw your Social Security. We've given you a lot of advice today, and you may be wondering, well, where do I start? To put it simply, start from the beginning, step by step, as shown in this presentation, and make sure that your financial tools and products that you're using today will help you on this path of becoming fiscally fit, okay? If any of these tools are missing from your toolbox, now's the time to reach out and grab them. We encourage you to compare products that are available to you, do the research, choose a program or financial institution that can help you. If you choose Northwest for some of these tools, here's some of the quick, here's a quick review of some of the services that we mentioned in this presentation that may work for you. If you're ready to get fiscally fit or just want to make sure that you're still in good shape, my team and I are a great resource for you. My team and I regularly conduct webinars like these, and more, as I stated earlier. So, you can remove that financial literacy obstacle from that obstacle that I mentioned earlier by continuing to look for, register, and attend our webinars, and just reach out to us because we're definitely here to support you in any way we can. So don't miss out. So at this time, I would like to open up the floor to any questions that you all may have. Denise, I'll kick it over to you.
Thank you so much, Chris. Very, very informative. I'm definitely one of those ones who eats out way too much. Learned a lot there, so thank you so much.
It's hard.
All right, guys, so let's pose the questions in the chat feature, if you don't mind, and make sure when you pose the question that you select to everyone on the top, opposed to just Chris or I, and I'll go ahead and read the questions for Chris, and he will go ahead and answer them. So here you go. I'll give you a few minutes to open up your chat. Let's see if we get any questions from you. I did get some beforehand, Chris, so let me read some of those to you if you don't mind. So when you were talking about the debt to income earlier, what's the percentage that financial institutions are looking for when it comes to that?
So what we preferably want to see is 30%, because, the lower that percentage is, that means you have more of your money that can be allocated towards, taking care. It shows your ability to be able to pay for what you have on a regular basis.
Excellent. Thank you so much. All right, we do have a comment. Would we be able to have a copy of these slides? And absolutely, I can send that around to everyone who's participated. And then we've got another question. Has the pandemic changed the amount we should have as cash on hand?
You know, in my opinion, I don't think that it's changed it. I think it's kind of more or less highlighted how much money we need to have on hand. You know, as I stated earlier, if you thought $1,000 was enough, or maybe you had that amount set aside for emergency, there are a lot more significant things that can impact your expenses, like a loss of income or reduced income. That's why when, you know, the other advanced suggestion I was making was 3 months, but it's going to be different for different people based on how you receive income and the frequency in which you receive your income as well. So if you're one of the gig workers out there, you might need more based on your line of work, because that income fluctuates so much. So it's going to be different for each person. At the end of the day, you want to have enough that helps you sleep at night, so that you'll be taken care of and you can pay your bills. So
Okay.
I think it's changed it. I think it's more highlighted need for it than anything else.
Sounds good. That was actually one of the questions too that we received beforehand. And then another one I received was, who do I contact to find out how much I need to have saved for retirement? That would be probably you or a financial advisor, then I would assume, right?
Yes, definitely reach out to me and also our Northwest financial advisors. We have a lot of great tools that we can provide to our members to really show you visually where you are and kind of take the emotions out of planning for retirement. Because when you think about retirement, you want to know, just like I was talking about earlier, what your measurements are. And that's really what we do. We take that information and we show you exactly where you stand relative to where you're trying to get to, and the right tools in place to help you accomplish your goals there. So just definitely reach out to us.
Okay, makes sense. Then we have a question here. My partner belongs with another bank. Will he need to be a Northwest member to meet with an advisor along with me?
No, he does not have to be, but I would strongly encourage him to be. So I will say that, we have a great relationship with our Northwest advisors here, and we walk in lockstep with them. So just like you have your investments and retirement, you have your banking and your loans and things. These things need to work together to accomplish, the collective goal here. So to answer your question, no, you don't have to be. But I think if you check us out, you might see a lot of benefit in becoming a Northwest member as well. Okay,
great. And I think those are all the questions we had. Let me just scroll through here to make sure I didn't miss any. Nope, I think that is all. So
awesome.
More questions coming in. I think we can move over to the raffle.
Okay. All right. So, you all got a little sneak peek on the raffle question, but I'm gonna pose it out there anyway. So if you don't already have the chat up, this is a great opportunity to take a few seconds to have it loaded up, get your fingers ready to type in the answer. The question that I want to ask you all, and the person that answers the question correctly and the fastest will win the raffle. So the question that I want to pose to you all is, what is the recommended debt to income percentage that I discussed earlier?
They're going in like crazy. You guys are good. You are fast with those fingers. All right, let me scroll back. Yeah. All right, it was Kathy. So Kathy, I have your email address. Ding, ding, ding. You're the big winner. I'll be reaching out to you and getting your address, etc. So I think I can send that out to you. I'm going to the office tomorrow, so I'll be sending that out to you. But in the meanwhile, so congratulations.
Yes.
Another question here, Chris, if you want to take this one real quick. Sure. Are construction loans a good idea?
Construction loans right now may be a little expensive, but in terms of it being a good idea, it's kind of hard to answer that question without fully understanding where you are holistically. So I think the first step would be to let's look at, remember I showed you the personal financial statement. Let's look at where you are financially as it pertains to taking on this new expense, this new construction. If you're looking at doing that, it may be fine for you. It may not affect your retirement or your goals at all. But the best way to do that is to look at everything all together to see what makes sense. So that's exactly what we do here. That's exactly what I offer to my members in partnership with Northwest Financial Advisors as well. So definitely reach out to me and I'd be happy to, bring clarity to that question for you. Hope that answers your question.
All right, I think we are good to go. And everyone, just to point out again, everyone's email addresses and phone numbers, et cetera, are on the screen. We encourage you to reach out to Chris, ask him any questions that you'd like. And of course, as I mentioned before, I'll be sending out the deck for you to take a look at. And as soon as the recording is out, I will send that around as well. So thank you again for being part of our webinar. And please make sure that you continue to check on that resource page that Chris mentioned earlier, to keep checking on other webinars, because we do have another partner called Coffee that puts on financial education webinars continuously. So please make sure to check us out. Again, thank you so much for joining us today, and hope everyone has a wonderful day.
All right, you all take care.
Bye, everyone.